G'day, how you going? And we're live Friday morning. Zero hangovers because we weren't at functions last night, so we're fresh and we're ready for our debrief of the week that's just passed. And this is our opportunity. It's a relatively new initiative. It's our opportunity just to give a sense of what we're seeing over the week as we sort of enter the weekend with through the lens of Australian real estate, but everything interconnected with it. And as I've been very vocal about, and it's an idea I've been forming over a period of time, that out of all the critical infrastructure for Australia, real estate is the most critical infrastructure. It's at the centre of our economy. It's at the centre of how we live and operate as Australians, at the centre of the health and happiness of many people, how they live, where they live, how they get on with each other, safety, security, everything gets connected with it. So quite a broad remit, this live stream, and you'll be tuning into this also on the Smart Property Investment Show or the Property Investment Podcast Network and other areas as well. We just really want to tackle what's happening every single week and give some commentary and analysis on it, interpretation hopefully, and maybe give you a different way of thinking about things. Joining me is my partner in this particular endeavour, Tarrant and Garman, who's the Managing Editor of Real Estate over at Momentum, and I'm Phil Tarrant. I'm a CEO of Managed, and you probably know me from a lot of the work I do in and around podcasting. So this is Smart Property Investment Show or the Contested Ground podcast. Liam, how you going?
Mate, welcome back. Well, I'm the one being welcome back. But,
you are welcome back.
Yeah, no, I've been looking forward to this all week.
This is the second time I've seen you this week because I heckled you out of the car
morning.
The car when your dog was doing a poo.
Yeah, about an hour and a half ago, and you were about 20 metres ahead of me,
yeah.
And I couldn't work out who was yelling.
There you go.
My eyes were darting everywhere, and I was like, it seems really weird because someone had a very deep understanding of what my dog was called.
It's on the lead, man.
Yeah, well, it is actually true, but I mean, at a distance.
See, this is they say don't put photos of your kids up on social media. Don't tell them where they go to school. But everyone knows your dog's Giuseppe, mate. That is
true.
That's poor security.
He's pretty famous.
It's
very bad OPSEC.
He's very famous.
Yeah.
My wife did say that your dog was very cute.
Yeah. Well, he's 2 kilos.
Yeah.
He fights anything.
Wet fight. Is he 2 kilos ringing him wet or just 2 kilos? Yeah.
2 kilos. 2 kilos and a half wet.
Okay.
Yeah.
All right. Well, it's not a show about dogs. It's a discussion around what we've seen over the week in sort of the expansive roles that we have. We're quite privileged at some of the work that we do. We get around a bit. We speak to a lot of people. We travel a lot. We can pick up the phone and pretty much speak to everyone. We're big consumers of information. A big part of your job specifically is really synthesizing that and sort of giving analysis and commentary across the myriad media products that you're responsible for. I think about REB or Smart Property Investment and other type of things. So it can be tough sometimes where to focus our attention. So this is really a good way for us to riff of what's going on. I was up in Brizzy Wednesday, Thursday for a big event we do in and around mortgage broking
the
again.
Space,
Mortgage broking market shares are highest it's ever been. It's a record level, 75-6%. I can't remember. A lot of conversations and discussions around what the banks are up to at the moment. Everyone's sort of got some big question marks around the major banks and their willingness to lend. We can go into that a little bit today. But I did have a chat when I was driving out to the airport, and you may have seen this on social media. I had a chat with Tom Panos, who a lot of people would know, who is one of the great commentators of real estate around Australia. And we had a good discussion and maybe a bit of a rant. Tom can get pretty sort of animated, as can I. So we know each other pretty well. We had a good old crack. But he did a post subsequent to this, which you can go and have a look at on the social media, just really giving a sense towards maybe the need to change the narrative around housing in Australia. This idea that success and failure in Australia is measured around whether or not you own a home. And I think as a nation, we really need to shift and change that. And we need a new version of the Australian story, which is very different than previously what it was, I think, when it come to housing. However, I'm very concerned and alarmed that I don't think our politicians get that. They're still the rhetoric from politicians is all around this emotive idea that it's every Australian's right to own a home, and they should all be able to own their home, which I think is a great endeavour for a lot of people to aspire to. But I don't think it's necessarily what a lot of people actually want these days, even though they've driven and drilled into them that that's what it means. So what we're seeing right now playing out in Canberra and other state capitals is this idea about how do we change the tax regime to ensure there is greater balance to sort of generational sort of aspects of wealth, particularly around housing. We saw Allegra Spender, who's an independent in Wentworth, come out with her sort of 70 or 80 page white paper on how she feels that the new tax regime should be developed, which is getting some currency in Canberra. We can have a chat about that today. But this is all, again, rebalancing this generational inequalities. Now, what I say is that you can't compare someone's Chapter 2 with someone's Chapter 8. You can't say a 20-year-old Australian should be buying the same properties that a 40 or 50-year-old Australian is buying. And I think we're really missing the mark at the moment. We'll have a chat about that. I had a really good discussion, Liam, on the Contested Ground podcast. And for those of you who haven't tuned into it, it's a podcast that I co-host with a number of folk, including Major General retired Dr. Marcus Thompson, who stood up Australia's information warfare department with the ADF, and we talk about everything to do with what's going on globally, misinformation, disinformation, foreign interference, everything connected with it. And obviously the big topic of conversation right now is what's happening in the Middle East and the war in the Middle East. So we pose a lot of questions in that. But it really got me thinking around how these external factors outside of Australia are really shaping the narrative, the positioning, the decision-making here in Australia. And some of the questions I posed on it, and we'll chat about, maybe we can kick off here, Liam, on this, because I know there's some other areas that I want to chat to you about today that you're a bit closer to, and that is in relation to maybe some of the changes in pest and building reform in Victoria. I've got some worries and concerns around that, so we'll get stuck into that as well. But let's kick off with the war in the Middle East. And you go and tune into a podcast I recorded around this on Contested Ground. We'll put the link in the notes. If you just want some more understandings, like, we've got a lot of property investors listening and tuning into this. So you might think, what does all that matter? Well, I stopped today and got petrol, and I paid nearly $2.60 for diesel, which is nearly 70 cents more than what I paid the last time I was at the tank. So
probably a week and a half ago, 2
a week and a half ago.
Yep.
So if you want to have an appreciation for what the war in the Middle East actually means in Australia, well, there's a very good reason why. And part of this sort of thesis I'm developing around this is, have we sort of mistaken our remoteness here for security in Australia? And absolutely not. And I'm not only talking about security from a defence point of view. I'm talking about security around economic security, fuel security,
food security,
everything. So some of the questions I've posed around this, and you need to be thinking about this. And on the Contested Ground podcast, we're going to do a series of wider discussions around this. But, has the war exposed that Australia is more vulnerable economically than military? Pretty important point. Are fuel security and sovereign manufacturing now more urgent than many traditional defence debates? So this is the idea around largely up until this point, even up until COVID, this idea around sovereign manufacturing capability was wrapped up in, hey, we need to be able to build and sustain the stuff we needed from defence. I'd say that really needs to be expanded out in relation to all other aspects of our resilience. Can Australia remain aligned with the US while avoiding another cycle of Middle East entanglement? That's going to be very tough. We've already deployed some assets in the Middle East, the E7 wedge tail, and also some munitions or missiles into it. But I can't see a direct military engagement there. Is the bigger domestic threat from Iran and this involvement kinetic, economic, cyber, or social? And this is going to be, again, fragmenting things. And does Australia have enough resilience in fuel shipping, supply chains, and social cohesion to handle a prolonged conflict? And already we're seeing this. And importantly also, what does all this mean? Well, the big discussions around the tax regime in Australia and how that's balanced or counterbalanced. When you get periods of conflict and contest, which is pretty much what the Contested Ground podcast talks about, what you see is it evolves and changes voting behaviour pretty quickly. Now, the current government's probably got another 2 years in the seat before we go to the poll. Now, whether or not any changes to the tax regime connected with property, they want to get out of the way this year under the May budget, then hopefully it will be normalised or absorbed over the 2 years and everyone forget about it at the election time. But we're already seeing, and you could probably speak to this, is a shift in voting attitudes away from some of the traditional voting blocks. So we see quite a large shift into One Nation, and whether or not that would actually hold up at an election, whether it's a sentiment right now. But the war in the Middle East has consequence here in Australia, and already. I've seen it. Now, I've been saying it for some time anyway. I've already been pricing in 2 interest rate increases into my personal finances for 2026. So I think pretty much every bank's now come out saying expect that. And they're all also talking about potentially copping a 50 basis point increase next Tuesday. So if you think the war in the Middle East has very little to do with Australia, I think we're going to find ourselves wrapped up in the globalisation of it. So quite a lot there, mate.
There is a lot there. And I think it comes down to, at the core of all of this is economic fragility. And now we spoke about this last week, so a lot of people that have joined us again and again, we don't need to necessarily rehash it, but in Australia, we have the economic complexity equal to Botswana. Realistically, we dig stuff out of the ground, we sell it, and the government relies on stamp duty. Those two things pay for the lion's share of our government revenues. Outside, and I actually did some research on this just this week, outside of the commodity sector, I mean resources, the next highest export that we've got is beef at like 2.1% and wheat at like 1.7%. So we really only rely on those two things. So what happens if there is a global shock and the global demand for our resources drops? Well, then it's going to have repercussions for the entirety of the Australian economy. Where it comes into fragility is that the global economy is relative. Now, in Australia, we have very high living standards. We make a lot of money. We have high per capita GDP. But this is relative because for the last 20, 30 years, a lot of our Southeast Asian nations have been growing, rapidly growing as well. So whereas in the past, we would say, well, we've got a relatively strong Australian dollar because our export market is so good. People are competing to buy our goods in Australian dollars, which keeps our dollar quite high. So we're able to buy things relatively more affordably than some of our neighbours. Well, our neighbours have growing populations. Our neighbours have growing economies. The Australian dollar is going okay vis-a-vis the USD, but any kind of shock, which means that there's less demand for iron ore or coal as a result of global instability, means that you will see a weakening in the Australian dollar. So our ability to buy fuel, our ability to buy oil from overseas. Now, we've got like 10% of the oil refinery capabilities that we had 30 years ago. We actually can't do any of this onshore.
This goes to sovereign manufacturing capabilities, right?
Yeah, absolutely. And it's going to have ramifications right across the economy. We highlighted this last week as well, but this is definitely worth mentioning again, because I definitely would not be shocked with 3 interest rate rises or 75 basis points in whatever iteration it comes in, whether it's 325s or 150. But what this is essentially going to do, when you look at the trimmed mean, electricity prices were already up 33% in 12 months. Housing gone up. What was actually anchoring CPI lower was abnormally low petrol prices. That actually anchored it lower. So the fact that it might double per USD per barrel means that it's going to be anchoring it higher. You're going to have interest rates in the 4, 5, maybe 5%. The 3 interest rate rises, almost guaranteed. What that's also going to mean in terms of property, going back to what our people want to listen to, and we touched on it last week, the level of business insolvencies in the construction sector that this is going to lead to is going to be quite catastrophic, to be honest. Supply is going to drop. We've already seen over the last week one of Australia's largest developers. I'm not going to say it just to keep it simple, just so we don't get any angry letters in the mail. But the level of fix-it orders that have been coming through was so great that they're now in an economically precarious situation.
Like defects that need improving.
Defects. Yeah. And now their lenders are stepping back and they're not going to refinance. So you've already got even some of our largest developers that are on the nose. So what does this mean? We've pushed so much liquidity into the demand side 5% deposit scheme. You and I have spoken about that at length. There's a lot of money going in. The supply is not going to be able to keep up with it. And the Australian economy is going to be in a very precarious situation as a result of it.
Yeah. This is this sort of notion around geographic isolation does not buttress against global interconnectivity.
You thought we would have learnt it during COVID.
Yeah,
Everyone during COVID
this,
was...
This is the issue I have, is that we went through that COVID experience and we everyone was at the time said we've got to fix our ability. We're so governed here by a just-in-time purchase culture where we outsource supply chains rather than create them here. And we can't do everything here in Australia. Let's be really clear. But there's a lot of vocal advocates championing for increased manufacturing capabilities here, and I completely concur with it. It's like we didn't learn. It's like, we got through COVID. Let's go back to exactly how we are.
Yeah.
And this is a big concern. So this I hope will be another wake up call. However, I do have great concerns around it because, and again, we're talking through the lens of property and real estate. Real estate is the least isolated aspect of the Australian economy. It is the most fragile when it comes to seismic global or domestic shocks. It's what hits most Australians most quickly, and you'll see that the rapid advancement of impacts here in Australia. This ain't going to go away quickly. It's just going to manifest and exacerbate an already very tenuous situation. Where I do get a little frustrated, and I called this out in the Contest Ground podcast I did this week, introducing a lot of these concepts and ideas, is already in question time. The government is pushing back, saying, "Well, don't you know there's a war on? We can't help these inflationary pressures." It's like, it's given them an opportunity to mask.
It's a scapegoat.
What has been some pretty abhorrent policy decision makings and failures that's set the property market up to where we are now. Whether or not this will take the heat out of some of the discussions around changing the tax regime, I don't know. But it's going to be giving them a situation which is going to provide a level of forgiveness, because they can point the finger over to the Middle East and say, none of this is our fault. We can't help this. Well, it actually is. It is the fault of the government to not be able to create the resilience we have here in Australia. Where the focus has been over the last period of time, the social contest between views and attitudes here in Australia has been encapsulated in protests on the street around wars and around circumstances and issues happening way outside of our shores. The eye has not been on the ball of the Australian government to be working on this idea around promoting Australian resilience. And here we are finding ourselves again in a situation where we're not ready and we're not prepared and we're not even thinking the right way. So, look at housing and real estate. Builders aren't building. It's too expensive. Inflationary pressures are going to come home to roost, and they're going to be, it's going to be an inflationary environment for a significant period of time. Materials aren't going to get cheaper. We still aren't working out the labour capabilities of our ability to build homes. The government is still so far behind its very ambitious objectives in housing constructions that they're never ever going to be able to keep up. So this is all just going to manifest, but still the narrative and discussions are around areas which really have no immediate relevance for Australia other than feel-good social causes. I don't know, mate. I have great concerns about it. We import about 90% of our refined oil here in Australia. Most of that comes through Asia, so we refine up in Asia. Where does Asia get their sort of base oil from? It's through the Middle East. 20% of oil in the world comes through the Strait of Hormuz, which is the pointy bit in the Persian Gulf that most people are familiar with near Dubai. There are other ways that they can get oil out. There's pipelines out through Saudi Arabia. There's pipelines out through Oman. There is a gap of that 20%. The Europeans have I think they've sort of said, we'll release enough oil to cover the gap, plus moving it out there. So it's going to be pressure on this for a period of time, but it just goes to show how exposed we are as a nation to a choke point, half a world away. And I'm not sure how that's going to play out. How the war is going to be shaping the discussion around interest rates. I think it's pretty clear right now that there will be rate increases just around the corner. It's to think of how war in the Middle East can really impact our monetary settings here in Australia. It just goes to show how vulnerable the economy is.
But let's not let the scapegoat. Let's not ourselves being captured by this scapegoat. I think it's very reasonable to say that looking at energy futures, looking at the fact that we already had 1-2 rate rises, given the fact that insolvencies had already increased with building and construction companies, given that we didn't really curb migration, given that now by the end of last year, 10% of all property purchases were done under the 5% guarantee scheme, all of those drivers of inflation were still pointing north anyway. And I've said this on so many podcasts, looking at the data, regardless of the war in the Middle East, I always said in 2026 you would have 2 rate rises, that the data was there. Also, I mean, it's just every major bank has said the same thing. Government spending is driving demand. It is government-led spending that's driving demand. And there was one report that came out, and I know this is very small, it's very fragmentary, but it's very telling at the same time, that to curb NDIS corruption, for example, the NDIS is now $52 billion this year. To curb the expected levels of corruption there would actually lead to economic ramifications in Australia, because corruption is quite literally in the billions. That to rip billions of dollars from the Australian economy by stopping people being corrupt would actually have ripples. That is demand-led inflation.
So you need those that corrupt dough floating around in order to put people in back pockets so they continue to spend. That's
ironically,
well, it goes back to the $15 billion that was sort of put into the coffers of the CFMEU, and like that money's in the economy is getting spent probably. So it's a great irony, and this is the point. The government doesn't really seem to
phased,
but they're flippant responses to it. It's just nothing to see here, nothing to see here. And this is the key concern. And to the point around the really good posts that Tom Panos put up on social media, you can see it on Smart Property based on a chat I had with him, is that we've got to really rebalance the books when it comes to housing in Australia, attitudes towards housing, thought and process towards housing in Australia. I feel, we flagged it so many times, 3 interest rates, say 75 basis point increase for when most people are subscribing to that 5% deposit scheme. So the government's gone, here's how we'll fix the housing affordability. And let's make it easier for people, first-home buyers, to buy housing. And let's put them in as much debt as we possibly can, 95% of the value of the property. So a whole bunch of people probably bought property that wouldn't have bought it,
and so they'd be bad assets. Now
they'd be bad assets, but we've never truly been in a negative equity situation here in Australia.
No.
So what is the Australian government going to do when it's sold all these first home buyers this dream of home ownership through being a really smart government and looking after them and helping them out, putting them in a 95% mortgages with no cap, so everyone, all you need to do is get 5% together. The government will sort you out at much higher rates, in terms of the price of the property that you can buy, and they're going to be slugged with another 75 basis points on their mortgage.
There's going to be distressed sales.
Yeah, but there's going to be distressed sales. Maybe that's deliberately what they want, but all of those younger Australians who have subscribed in that are going to be going to the government. Well, you've got to bail me out. You're going to bail me. So is the government going to actually start helping them pay their mortgages, or are they going to be like, well, you're going to have to work a bit more? Your wife's part-time jobs now is going to have to be a full-time job. So you go back to work. What happens then? Obviously, the government's going to raise some more coffers. It's really, really fractured at the moment.
Now, I
don't see a way out of it.
And what I'm about to say, I don't actually think it's going to happen, but it's the logical extent. So if the government's paid for the lender's mortgage insurance, and then several thousand plus Australians then default essentially if they're a negative equity, or it's the insurers that are going to be left holding this bill, which is
the insurance are short against it. They don't care.
But I mean, that was the genesis of 2008.
Yeah.
That was the genesis of 2008, where real estate stock, which was bought at elevated levels, everyone started defaulting, and then it fell onto the insurers, and then the insurers started defaulting. Right now, I don't think it's going to happen. There is so much liquidity in the Australian market that, again, we're talking to people. I know I mentioned this last week, but we're talking to agents out in Perth.
There's more supply than demand.
There's
more demand than supply.
The fact that you've got listings in the single days primarily led by owner-occupiers does show that there is still a lot of owner-occupier money going into it, and there is still an inherent flaw that people want property at its current price. But that doesn't remove the ethical considerations. And to your point about intergenerational well-being and intergenerational equity, why, if you care about intergenerational equity, would you put young Australians at risk of negative equity if you really cared?
What I don't understand is this notion of entitlement around it, which is this concept, right? Like, stay with me for a second. This idea of going, it's unfair that younger Australians can't have a house earlier. It's unfair that this older person, 40s, 50s, 60s, has more wealth than a younger person. So we need to rebalance things. This is I think it's absolute folly. There should just be an understanding expectation that younger people are going to have less wealth than older people. So they're on a journey to create wealth. So let's give them the means and the mechanism to do so. And I'd like to think Australia can do that. Unfortunately, what's happening is the other side of things is that they're starting to disincentivise aspiration in Australia. It's all too hard. Why would I want to invest in things when they can just change the tax regime in a heartbeat? So why don't I just sit around and I'll just wait and I'll just subscribe into the government coffers at a point in time and I'll just retire on a pension. They're penalising. They're penalising the passionate aspect that makes Australia great, and that's trying to do better than yourselves. They're just making it too hard around it. And we see this white paper that's been put out by Allegra Spender, member for Wentworth, independent, and what she's proposing, and look, I'm sure it's going to get a bit of it's been getting some currency, but it's going to it's going to get some airplay, and it has got some airplay with the Prime Minister and the Treasurer. This idea of a revenue neutral tax reform, right? And that's what she's putting together. And she's saying that the intergenerational rebalancing of the tax burden was essential to ensure the Australian ideal that you can get ahead if you work hard was not lost for younger generations who are struggling to buy homes, have children later, starting fewer businesses, etc. So this idea of like getting ahead, what she's proposing is that you pay more tax on income which is generated through investments, and you pay less tax from income that's generated through effort. So if you're working in a job, you're going to pay less tax. If you're making money through investments, you pay more tax. I sit there and I just sit and think and go, well, isn't that disincentivizing people to invest? And therefore they'll probably spend any money on greater spending,
so
which is inflationary.
Where does the start and end of it come from? So if you're saying, what about business owners? So you own a business. Does that mean is that taxed as a job, or is that taxed as the owner of a business?
Well, it's going to be taxed as the owner of a business, right? So let's go through. So this is the idea of saying that if you go to work, and this is again, it's just like maybe Australia is still caught up. It doesn't really know who it is these days. It's caught up in these old-fashioned ideals of post-war Australia where people go to work and they do a hard, honest day's job, and then they come home and there's food on the table, and all this sort of perfect utopic idea of Australia. Things have changed. People don't, like younger people, don't have traditional jobs, or a lot of them don't have traditional jobs anymore. They have multiple gig economy works, all that sort of stuff.
I'll add some flavour to this.
We're stuck in the middle somewhere.
I do feel sorry for young Australians. I feel sorry for young Australians because I think a lot of young Australians have been sold the fib, and not that I'm saying like generationally have been sold a fib, but I'll give examples, and I know that you would agree with me on this, but a societal expectation that if you don't go to university, you're a failure.
Yep.
And that's a societal expectation, and parents push that on their children. It's like, what you want to do a Mickey Mouse degree for 3-4 years, leave with 40 grand of debt, more than that, enter a job market which it's and not to be. This isn't being snobbish or elitist, right? But when you have 50-60% of school leavers all go to universities, what this has meant is that you've got good degrees and high entrance marks, but you've also got these universities that have, you can become a teacher off of a 58er. Like, that's objectively a bad thing, by the way. That is objectively not good. Maybe there are some people that shouldn't go to university. Maybe university is not for everyone. Hey, actually, you can get a skill, you can get a trade. You can get, the second you're 18, you get that $10,000 bonus from the government. Go. Spend it on your beer, whatever. But, you rock up to work. It's going to be a hard slog. And in 4 or 5 years, you'll have the certificate. You can start your own business. By the way, after that point, when you're starting your own business, your mate's just graduating and he's going to be on a graduate salary. You're probably going to out-earn him by 2-3 times.
If he's lucky to get a job.
If he's lucky to get a job.
Yeah.
And I do feel sorry for young people because they've been led down the garden path. And I would say, I think she's a very nice person, but it did start with the education policies of the Gillard government where they uncapped the number of people going to universities. And they said, we want at least 50% of school leavers going to university. Why?
Well, look where we are right now. Mate, you only need to see how many Atlassian workers are on the chopping block yesterday and today. They're just getting canned. These are all going to be university-educated developers who have just been canned.
Yeah. Now,
Phil,
we
because of AI.
we do have a question.
Okay.
Now, it's a little bit out of. Actually, we got a happy Friday. Happy Friday, Scott. Hope you have a good plans and a good weekend. We do have a question from Sean. Now, this is different, a bit of a step change from what we're talking about. But does the potential CGT reforms adjust your personal investment strategy? I'll start off with this.
Yeah.
My wife and I. Last week, actually, Phil and I were talking about it, and I said to my wife when it started coming through, I'm like, what do we do? Do you sell? She's like, no, just hold it a little bit longer, and that's what it comes down to. I think property investors have been conditioned for this sugar rush, and we were talking about last week, this sugar rush of, I'm getting these 20% year-on-year returns, I could potentially retire after 5-6 years, rip out equity, buy more. Up until 2017, that was not the notion of property investing in Australia. You had to buy for the long haul. You had to be ready for the ups and downs. I've been very fortunate to learn, in terms of my property investing journey, I've been very fortunate to learn from yourself and a mutual friend, Alex Whitlock. And one thing, when I was doing a podcast with Alex, and he said the two of you used to go to auctions together, and you would have your absolute dead limit. You wouldn't go $1,000 above it. Yeah. And he says, looking back, like, we should have pushed that extra $1,000, but that was the time. You didn't get those bumper returns. You might have to wait a few years. You might have to pull more money into to manufacture that cash flow and actually fix up the house, which meant you had to be economically able to weather an up and weather a down. It wasn't those years of the 15, 20% annual returns. Go back to the basics. Ensure that you are able to weather this for the long term, because you're in a 30-year game. You're in a 30-year mortgage cycle. You're not in a 5-year up and down. Now, what it would potentially mean, what I'm personally doing, is look to pay off a little bit more. Like, hold it on for your children.
Hold on for as long as you can. It'll just change the settings. Now, the issue I have around the CGT, and I want to talk about this because Allegra Spender sort of proposed some ideas around it. We spoke at length around other sort of policy proposal in relation to what Picker is doing, Property Investment Council Australia, Ben Kingsley and co. It's a lot more fundamentally. It's a lot more fundamental to me how I rationalise this, and it comes to this point. You can't lie to Australians and the Australian population and think you're going to get away with it. It's really, really simple. How can a government potentially change the rules that people have been following for decades in order to prepare and take ownership of what a comfortable retirement would look like for them? You can't just take that away on a flip of a coin. You cannot lie. You cannot lie to that level to Australians. You will rip the heart out of Australia if you take away the CGT discount on the basis of not grandfathering it. And this is a key point for me, and to the point around the question, is whether is something going to happen to the tax regime around property? I have it on a good account that, yes, something will happen. And it looks like they're still trying to work it out with people proposals in there. But fundamentally, this is going to be the core point, and I think there's going to be a battleground, an absolute battleground, potentially now, but then also hopefully Australians will remember this when it comes to the election. That is the non-grandfathering of the tax regime up until this point. You cannot take that away. But it appears, and it would seem that the government is in such a dire situation that it needs money that it's not going to grandfather the CGT tax regime up until this point. And the very fundamental reason why is that if they say now, we're going to turn the CGT discount to 30%, we're going to take it away completely, whatever the setting is, right? They're going to not be able to grandfather because they need cash now. So if people are buying new investment properties today on the basis of knowing that there's going to be changes to the capital gains tax regime, the government's going to have to wait 5, maybe 10 years in order to receive the benefits of that change, because someone needs to buy a property, it needs to go up in value to a point where someone's going to sell that property and pay tax on that. So if I buy a property today, they're not going to get the upside in a year's time on a change of capital gain. Not it's going to be 2 years, 3 years, 4 years, fine. They're going to have to wait probably up to a decade in order to see those benefits. So why would the government of today, who is hemorrhaging funds and has run out of dough, introduce tax changes that they're going to see the consequence of in 10 years' time? The governments can't think beyond one election cycle. Yep. That's 3 election cycles, right? So my fear, and this is where Australians may really cop it, my fear is that they don't grandfather these changes. Now, look, whether or not there's going to be changes to the capital gains tax regime, so what? Yeah, it has to be grandfathered.
Well,
absolutely has to be grandfathered. But I don't think it's going to happen, mate.
You know what? Like, it's do or don't. It doesn't faze me. It doesn't faze me, do or don't. I mean, obviously, I've got a preference, but at the end of the day, I think the market's going to correct such that that extra money that you would pay in tax anyway would be absorbed by fewer sales. So, for example, there are postcodes with recent data. Now, Brisbane's had a fantastic, phenomenal run. Now, there is data in certain Brisbane postcodes where you've got like an exodus of 200 investors. They're putting their stock on the market. They've realised their gain, putting their stock on the market, happy to add supply. Fantastic first home buyers, whoever wants, families can come in the market, buy their PPLR. They're just not going to list. They're going to hold them. They're going to hold them for the long term. You highlighted this last week, Phil, which is 50% of property investors have positively geared portfolios. If you go back to the fund, and this isn't financial advice, of course, this is just literal consideration. If you go back to the basics and you're not thinking these yourself 1-2 year cycles, but you're in it for the long haul, that, hey, I've got potentially an inflation busting asset, which with slow rental increases over 5-10 years, it will become positively geared. By the time I retire, I've got this fantastic asset to pass on to my children. It's going to be earning me money in retirement. Perfect. You're just holding on. And you're not even putting stock on the market. What probably going to realise when Australia's 2.8 million property investors, a lot of them are going to realise, like, let's not list. Let's not get rid of our excess stock. Stock levels are going to plummet at a time when supply is already plummeting. So to your point, I actually do agree. It's either there's 3 reasons for increasing CGT essentially, or getting rid of the discount is increasing affordability and decreasing house prices. Not going to happen because the banks will collapse.
Won't change it.
Is it punitive for property investors? Yeah, I think there's a bit of
it's easy
malice.
Target.
It's an easy target.
Easy target.
It's just adding to government coffers. That's where I think it is. I think it's just a smash and grab. But as a result, less people are going to sell.
It doesn't move the needle enough for me in terms of making these changes, in terms of the how it will balance out in terms of greater tax receipts. Like all businesses, if you're in the red, i.e. you're losing money rather than making money, you look at both sides of the P&L, revenue and expenses. There doesn't seem to be any real smart focus on pulling back spending. And that is probably an easier way and less brutal way
100%
to balance the government's books.
Mate, we could have our cake and eat it too. And that's the craziest thing. When we were talking about the state of the Australian nation, right? We can have our cake and eat it too. If we didn't have, say, several $1 billion in NDIS frauds, fantastic. You could actually cut income tax.
Like you just cut that back.
Yeah.
Stop the rorts, and you'll probably make more money than what you will by going after property investors.
If you really want to help people, then with that several $1 billion, okay, increase the tax-free threshold. So young Aussies can go out to work at a bar and get an extra $20, $30 at the end of their shift. That's a great thing to do. And we're not losing any money at the end of the day. Actually, it'd probably be better for the economy because they're going to get their $20 extra at the end of a shift and go and spend it at the local cafe.
Put it in the pokies.
Or probably put it, like, was it a Bricky's, a tradies?
Bricky's laptop. So approaching the budget, which is the 12th of May, in Treasury I've been looking at capital gains tax, negative gearing, trust, fringe benefits tax, electric vehicle exemption, all that sort of stuff. So Allegra Spender, her idea is to reduce the CGT discount from 50 to 30%, and tax trust distributions at a minimum rate of 27.5%.
Trusts as well.
So there you go. Yep. So this is to your original point around how it's going to be viewed. Yeah. So 27.5% rather than the normal tax rate. To deter income splitting to spouses and children in similar ideas to that Labor's exploring. So this is this idea again that, and Australia needs to have a really uncomfortable conversation with itself about who it thinks it is. You know, we've moved on. We've moved on the nation and this narrative that we adapted and embraced after the Second World War. And I would say at that time, remember also up until the 70s, we had a white Australia policy. We've moved on a lot as a nation, thankfully, around that. But it's like people who are an aspirational, people who are deemed to have greater wealth than others are certainly pariahs, and they're certainly being attacked across every sort of level. So what she's saying, so a budget-neutral personal tax reform with every dollar of the $29 billion in annual revenue raised in a year from higher taxes on assets ploughed into personal income tax. So let's tax investments different to people's effort, right? However, it's the effort that creates money to invest. So
I mean, there's the argument on the other side that so many people see property as just a very reasonable store of value. You're not out there. You're not predatory.
I wouldn't be put in the stock market today.
Well, exactly. You know, it's a store. You know, when inflation realistically, you know, with or without whatever economist tries to cut it up in whichever way possible, you know, if inflation's around 5-6%, you're just putting it in a store of value just to the safety.
Yeah, you chuck it in there, you get your inflation, and you would like to think you get the system growth if you're investing well. So she's saying cut the bottom marginal tax rate from 16 to 30%, and cut all other marginal tax rates across the income spectrum by 2.5 cents for every dollar earned. So for someone earning about $100,000, they'll save $1,600 a year. She also says reduce CG discount on investment from 50 to 30%. She's saying previous capital gains will be grandfathered until the date of commencement, but future capital gains, including on existing investment, will face the less generous tax break. So at least she's sensible enough to say, you know, grandfather it. So what I think she's proposing here is she's actually looking forward into the future rather than immediacy of we need money today.
So it's a bit more moderated than what
it's a bit
some
more
of the
moderated.
Yeah.
Introduce a 27% tax rate on income from investments and remove the tax-free threshold for non-labour income. A change, she said, would reduce the artificial incentives to create family trust.
So she knows her stuff.
Yeah, she's smart.
Yeah.
Right? She's a smart operator. And,
Yeah.
she's saying phase out negative gearing over 5 to 10 years by permitting deductibility of investment losses only against gains, which Spender said would reduce the artificial incentives to borrow to invest, particularly in housing. Which, you know, I think Keating had a crack at this and it didn't really work too well. So I've read this, and I tried to read the white paper on Wednesday night when it came out after probably, you know, I was out of the function, and I had to try and reread it again yesterday. I'm reasonably sophisticated in my ability to absorb information. Most Australians, if they read that, it would be absolute gobbledygook to them. They wouldn't understand it.
Yeah.
Already our tax regime and the rules governing it are extremely complicated, and I think a lot of this would manifest in even more rules that most Australians won't understand. It's going to make them difficult to actually get ahead. And the issues I have around this is that they're going, trust. A lot of people invest in trusts for reasons other than tax efficiencies. Let's remember that, and that's never documented anywhere. You know, for the purpose of, you know, generational wealth, whether it's for protection mechanisms and stuff. So having a crack going, you know, let's tax trusts more to stop people around it.
Before you get married, and prenups.
Prenups, you know. So that's an easy way to do it. Having a crack against property investment, you're just disincentivizing people from investing. And again, it comes back to this uncomfortable conversation that Australia has with itself, and no one is saying this. You know, you're talking about cut the bottom marginal tax rate from 16 to 13%. Those people at the bottom marginal tax rate aren't buying properties, and this is the really tough conversation Australia needs to have. If you're at the bottom end of the tax regime and you're paying the bottom marginal tax rate, you're not going to make enough money for a lender to borrow you. You're not making enough income for a lender to be satisfied to lend you money to buy a home.
Well, I
So,
think
so
that's-
you're going
yeah.
to be renting.
I mean, that's wealth redistribution. I don't
You're
necessarily
gonna
think
be renting.
the tax breaks for lower income earners is to buy a house. I think it's just wealth redistribution. But as we kind of highlighted, I think you can do that.
But
just
these
through-
are these are a lot of
Yeah.
the people that the government or the system would be telling you, we need to make these people aspirational. These
that's
people,
true,
let's
yeah.
make them aspirational. And let's give them
them
this
subprimes.
idea
Yeah.
that they should be buying a home.
Yeah.
They can't functionally buy a home because they don't generate enough income. So what do they need to do? They've got to generate more income, or club up with someone, get married, and double your income. There you go, right? But lenders aren't going to be lending them money, unfortunately. So therefore, they need somewhere to live. Fortunately, there's property investors out there that provide rental accommodation. Third of all Australians rent, and a lot of the time, it's going to be people towards the lower end of income earning who are the renters. You know, that's great. They're the heartbeat of Australia, the bedrock of Australia. These people who are maybe towards the bottom of their tax system. Stop selling them a lie and getting them into 95% home loans,
Yeah.
which means they're going to be stuck.
Yeah.
Create an environment, and there's been some good reform around it, create an environment to give them long-term safety and security around rental accommodation, which is underpinned by the Australian property investor. Anyway, any more questions, mate? Probably a few coming through.
We do, but it's about cross-securing loans. So I think that might be better for an expert. Hey, Scott, I think it's Scott. Is it Scott? Yeah, Scott. What we're looking to do on some of these live streams is we'll be bringing in experts, accountants, brokers, and with questions like that, far more appropriate to give it to the experts rather than us armchair.
Yeah, go look. I've done a lot of podcasts around cross-securing, cross-collateralizing, cross-securing properties.
Maybe go back.
Go and check it out.
Munzerl would be with
Munzerl with a whole bunch of people, and
Yep.
and I think not advice by any means, but I try to avoid it where possible. However, there will be times in cases where it does make sense to do that. You really need good accounting advice around it because it may solve problems for you, but it may create more problems into the future, which is good. So tell me what you've had some good chats over the week in relation. We'll close out with this. I don't know how we're going for time, but in relation to, and I just bought a place in Victoria and the regime around preparing that for rent is quite considerable.
It is.
And I think there was 100 and something changes to
The property.
the properties. It's just ridiculous. Yeah, some of them are good and stuff, but down in
Was that
Victoria.
100 changes that you had to make on your place?
No,
just generally.
the tax
compliance,
the tax and compliance regime.
Yeah.
So, but it's getting a bit sort of fishy when it comes to pest and building.
Mate,
down there.
I'm pretty unimpressed with the Victorian government. I can't believe I keep saying this. I just it's
Do you know Melbourne was voted the best city in the world to live? Better than
you know,
did see that?
everyone in the comments of that was, I can't believe it, I can't believe it. Oh, I kind of still get it. Like, when I was a kid, I lived in London for a few years, and if you live in outside of Mayfair and that, like if you live in real London, it's a pretty rough place. And I don't mean like the Aussie expats that go and live in Fulham. You know, like if you live in real London, it's rough. If you live in real Paris, it's rough. Went to New York 2 years ago, hated every second of it. No, that's an exaggeration. It's a rough place, right? In Australia,
It's gritty.
It's gritty. We don't appreciate how lucky we have it. Truly. So yeah, a lot of people were like, "Oh, I can't believe Melbourne's voted the best place to live." Probably is. Or Sydney. Yeah, I'm a Sydney sider. Probably is. For now, anyway. Maybe we need more machete bins.
We need more machete bins.
need more machete
That's a
bins.
great policy that's worked out. There's been no machete crime down there.
Zero since they introduced the bins, right?
I would have thought that you just put your machete into the bin.
Yeah, I mean, I was going to make a joke about carrying a machete around, but I'm not going to do it because obviously I don't. But
Your machete are your words.
my pen is my sword. Yeah. My podcast is my sword. Yeah, I was going to make a joke about using a machete bin, but oh gosh, it's ridiculous. If you're getting to that point, you genuinely think that's a policy when that's ridiculous. But this week, the Victorian government announced that they were following through with plans to make sellers pay for building and pest reports. And I see this news announcement come out. And I'm like, sellers paying for building and pest reports. So I take this philosophically, right, Phil? You as a buyer get a building and pest report done to protect yourself. You're putting potentially hundreds of thousands of dollars into this asset as a deposit, but over the life of the loan, you're paying probably millions of dollars into this asset when you factor in inflation, interest and everything that you pay on it, right? You get a building and pest report to protect yourself. You pay the $500-$600, you get the building and pest done, you fix it up, and in an ideal world, that building and pest inspector is on your team. As the buyer, they're on your team to highlight everything that goes wrong with it. So in 6 months' time, it turns out that you didn't have a leak, which ate through all the wood, and now suddenly you have to replace half the house. And that does happen quite often, right? They're meant to be on your team. So the Victorian government came out saying that sellers are going to be paying for building and pest. Now, this was a Real Estate Institute of Victoria-led policy, which they put out in one of their blueprints. And to be honest, Phil, I don't necessarily understand the logic of it. So looking forward, the world according to Liam, right? Sellers pay for building and pest reports. What does that mean? Every shonky building and pest inspector, they're going to have a boom. They're going to do a great. They're going to come out of this really well because every seller out there is going to be like, oh, don't want to highlight any major defects. Get the shonky dudes in that is going to sign it off. And here's your building and pest, and you can pass this on to everyone.
It's a bit cynical saying that all
it's
pest
not
and
well.
builders
It's
are dodgy.
No, I'm not saying all of them are. There are a lot of really good ones. But the good ones aren't going to get the work because the good ones are on the side of the buyer. The good ones are honest. Good building and pest inspectors are honest. They do a good job. They go through and they document everything that could be good and bad about the place. No seller, if the seller's paying, is going to want a truthful one. Unless you're the most ethical person. I would never take money from someone. I would never cover something up. That's my bad roll of the dice if I've got a major defect and I go to sell. But there are going to be a lot of people who will. So the ones that are going to sign off on everything, they're going to get a boon. They're going to have a great time. The honest building and pest inspectors who are going to document everything, no one's going to go to them. No one's going to use them. So I was talking to a few friends who are building pest inspectors down in Victoria, and I basically said to them, my take is that the dodgier inspectors that are going to sign off everything, they're going to get heaps of new clients. They're going to get a lot of new people coming through because the seller's going to want to cover up their faults. Buyers are going to be screwed in the process because they're going to be given bad reports. And good building and pest inspectors who will be honest about faults, they're going to have to fight to educate buyers as to why buyers should still be paying that $500-$600 for a building and pest report because they ain't going to get any sellers as clients. Good inspectors get screwed and bad inspectors are going to grow. But there's one other thing. So shout out to Miles Clark and the team at the Victorian Association of Home Inspectors because they kind of came as
They've got an association.
Well, they kind of come together as a result of this. These are really ethical dudes. These are good dudes. So
Dudes and dudettes.
Dudes and dudettes. So in Victoria, there isn't any kind of a licensing requirement to be a building and pest inspector. You do your course, you get your license, and you come in. So really, anyone can do the prerequisite course and become a building and pest inspector. You don't need to be a tradie before. You don't need to be in the construction industry before. Miles spent decades as a tradie. He and his crew spent decades as tradies. And what you're going to see is a lot of people are going to be kind of entering the scene because there's just going to be more demand for building a pest. But one thing that he did highlight was that there's going to be some perhaps inconsistencies when it comes to liabilities. Now, what would be the case, Phil, if you and I go and buy a house, and as buyers, we get a building and pest inspector to go through that house. And let's say it's ravaged with termites. And that building and pest inspector failed to pick up on it. Now, I don't mean because there are reasonable levels of flexibility. They can't necessarily check in every crawl space if they can't fit in there. And that's a reasonable liability that they have, and they will be honest. And in a good building and pest report, they will say, we have been unable to check this crawl space because it's too small. And they will be very upfront about that. Or we can't pull out the dishwasher and go behind the dishwasher. That's not reasonable. What they will do is they'll go into attic spaces where they can or go into houses where they can to look. Now, if you hired a building and pest inspector and it turns out that it's a very big open cavity and they just clearly never checked, well, they would be held liable for it. And it'll be their insurance, which is going to stump up for that. However, what Miles and the team were explaining to me, I had a chat to them yesterday, was that the agreement is with the person who's buying the building and pest report and the building and pest inspector themselves. So in this situation, the seller is the client of the building and pest inspector. That liability and that insurance is between the seller and the building and pest inspector. So if the building and pest inspector comes out, it's a shonky report, termites have eaten through the place, there's leaks and they just never declared it, that liability doesn't necessarily extend to a third party. That liability is between the two people in the contract, which is the seller and the building. The seller's gone. They don't care. The person who's going to be left holding the bill is the buyer.
But that becomes a civil matter then with the vendor who sold the property. If you've purchased the property based on information provided by them and it's found to be fraudulent, then that will be a civil matter against it. So this is interesting. However, isn't the remedy to all of this just go and get your own pest and building report?
You have to. But there are going to be a lot of people. You and I are very informed. And that's the difference. There's going to be, vulnerable communities.
So why is the Real Estate Institute down there put this in place? So are they going to change the construct of contracting in relation to this, saying that because they're providing a pest and building report as part of the sales process, that can't be a contingent
potentially?
That can't be a contingent thing when you're contracting, saying I want a clause, a 14-day pest and building to work out. They're going, well, look, now this report says all okay, you can't have that anymore.
Potentially.
Really?
It's too early on. I would say it's too early on to know, because it's still. So REIV provided this blueprint. The government's now announced its intention to put it into policy. So I think there's going to be a lot of stuff that comes out of the wash. I think. So
the policy is that the vendor has to present the property with a pest and building report.
Yep.
Okay. And they obviously pay for that.
Yep.
Okay. So what's these guys' beef then? So they're saying that they're going to say it's going to compromise the quality of pest and building reports, and or whoever is the cheapest is probably going to get the job.
100%.
And because it's cheaper, it's going to. So they're saying that they're going to be out of business.
Well, not necessarily cheapest. It's going to be the people that are going to produce reports in the best interest of the seller and not in the best interest of the buyer. You don't want your buyer's agent copying fees from the seller.
And then on that basis, then I would say there's potential for the good guys to really drive their businesses forward, because I would be ensuring that every single buyer gets their own independent report, which is right.
And that's,
what then is why is the Real Estate Institute of Victoria trying to put this in place? What's their benefit? Because they're going to set up probably a company, or they may be getting some sort of like connected partnership fee from all these. I don't know. I've got a question mark around a lot of the REIs.
So the blueprint proposes a more nuanced and holistic approach for government to adopt pricing transparency. Pricing transparency. Now, and I came out on the attack to balance it. I understand. I speak to a lot of people in the real estate sector, especially when it comes to things like underquoting. We were talking to an individual in Western Sydney with an agent just a few weeks ago who was. Had his license suspended, and we were talking to this individual in Western Sydney, and they had to go through like 5, 6, 7 building and pest reports, and every time he went to the auction, he just was never even in the running. It would just go $400,000-$500,000 over price, right? And what this individual told us, under anonymity, was like, mate, I ended up spending thousands of dollars on building and pests. I now need to get off the market to resave to come back to the market.
And here is the problem, right? Because your structure, if you've got a good conveyancer or a lawyer, or you're familiar with this, is that you can buttress against this on the basis of a proprietary sale. You just look at the pest and building report and you go, yeah, it looks all right. Okay, I'll put my offer in, I'll get accepted. I'll have a 14-day clause on pest and building. But I think in Victoria, there's got to be good cause for like significant issues with pest and building to rescind a contract, right? And I think this is maybe the point. But if you're buying at auction, you don't get that opportunity. Yep. So it may reduce, the propensity for auctions in those areas, because you're not going to want to get a pest and building for
this is where it's going to become a conveyancer's game. And I don't mean it in terms of like conveyancer's going to have a boon, but I mean in terms of getting a good conveyancer and making sure that it's watertight. So you need to make sure in your contract that the building and pest clauses include your building and pest report. Like you're going to have to fight that in there. this is early, so we don't necessarily know whether they're going to say, well, we've already it's clause and we've given you the building and pest and it's based on our building and pest. You're going to have to fight for your own building and pest to be in there. Yeah. You're going to have to fight. Again, too early to be seen, but to make sure that those clauses that you can remove yourself.
Why is the real estate industry doing this? So they're saying, it's going to be
pricing
fairer.
transparency,
So
fairness. But in my, you're just going to have a boon. It's an unregulated industry. You do your 2-day course or whatever it is. You don't even need to be a tradie before you come in. Looking into the crystal ball, we're going to be talking about this. You and I are going to be doing our live stream in 2 or 3 years. We're going to be hearing about all these examples of vulnerable communities. You and I know property, right? If you're a new Australian, you're buying your first house, and you have some very good-looking dude dressed up in his suit, handing you the building and pest report. Oh, it's done by so-and-so, and you look through it. This is all honky-dory. You might actually believe him. You might not realise that, hey, in your best interests, double-check and get your own building and pest. And that, at the end of the day, my heart goes out to the buyers to make sure that I don't want the buyers in 6 months' time.
Buyer beware.
Buyer beware.
Buyer be educated.
Yeah, buyer be educated. Mm-hmm.
There you go. Hopefully we're helping with that. Well, good chat. Quite a lot there around tax regime, tax reform, war in the Middle East, pest and building. It's quite a broad remit. Expect interest rate rises, team.
Yep.
And what I always say is always expect there'd be some sort of seismic shock that will face property investing. And what's happening right now is it's around the fringes. I think a lot of the impacts can be contained if you're focused and prepared. I'm looking at this market, and what will happen. It'll wash through in relation to whatever changes are to the tax regime, impact of what's happened in the Middle East. How long and prolonged those effects will be, who knows? But I think it will certainly slow down the process of Australia moving more rapidly towards improving the supply side of the real estate equation. So what does that mean as a property investor? Well, there's certainly opportunities there. Interest rates rising by 75 basis points, we're pretty much just losing all the benefits we had of those rate reductions last year, was it? So it goes back to where it is. It's the cost of doing business. Make sure you factor it in, pricing it in. And there will be sort of second and third order effects in relation to rents connected with that, potentially better performing yields on your property investments, maybe more opportunities in the market for if you do find people sort of responding by selling property, that may have a short-term blip. I think Louis Christopher come out this week, who's from SQM, and he's revised his 2026 predictions from potentially up to 10% in some states down to 0 to 3% in some, and he's viewing Sydney and Melbourne in particular as being quite lackluster as a result of some of these changes and also these impacts that we see, which may be inflationary, which will be inflationary. He's still saying that some of those resource towns like Perth are looking pretty good, so you go and check all that out. But this is the brief. This is what's going on. I'm off to a St. Pat's Day function now.
Oh, the annual lunch.
The annual lunch.
With some of our colleagues.
The biggest St. Pat's Day lunch in the world.
In the world.
Business lunch in the world. So I've got an afternoon of...
Whereabouts? Coogee? County Coogee?
No, County Convention Centre.
County Convention Centre.
There's about 12 or 1,300 people go to this lunch.
I know,
so
I remember. I didn't go last year, but I know a lot of our colleagues went.
Yeah, it's typically a good day. And I've been to this beforehand, and it's sort of the last couple of years less so. Maybe politicians aren't as fun as what they used to be. But I remember going to this function once, and they had the Prime Minister.
Oh, yeah.
And they had the Leader of the Opposition.
Yeah.
Then they had the Premier, and they had the Leader of the Opposition.
How many years ago was that? I'm trying to work out who...
It was back when Christine Keneally was there.
Christine Keneally?
Yeah.
Well, as Premier?
She wasn't there. So I think she was there as the Leader of the Opposition of the...
Well, she would have been Premier like 2009.
Was she Premier? It would have been then. And I think it was Julia. Maybe it was Julia Gillard.
It would be Gillard.
It was Gillard. And who was the Leader of the Opposition when Gillard was around?
Turnbull or Abbott.
Yeah,
One of
it
them.
would have been Abbott maybe.
Yeah.
And it was good fun.
Yeah.
And they sort of spirited things. They have a red hot crack at each other and good fun. So it's a good
that
lunch.
was an era of politics. I think it did change around 2008, 2009, where there was a little bit more. There was a little bit more camaraderie, and I've got a lot of friends.
Esprit de corps.
A bit more esprit de corps, and even though we don't necessarily all agree with one another, I know a lot of people that were in close proximity with Gillard and said she was a incredibly nice person, like an incredibly good person. It was a. You don't necessarily have people saying that about their political opposition.
Well, just
nowadays.
go and watch Question Time now. If you like good sport, it's good. But to this point around how the war in the Middle East is going to make a lot of government decision making up until this point a little bit more forgiving for them. Make sure we hold the government to account. That's the nature of the political system here in Australia. And don't put up with mediocrity. Don't put up with lies.
Well, I mean, I think you might need an opposition to do that, right?
Well,
that might be the next
nation.
podcast. Yeah.
One nation. God. But let's as a nation make sure we make more stuff here, I reckon. Mm-hmm. Resilience, national resilience is key. Thank you, Liam. Smartmoneyinvestment.com. If anyone gets in touch, you can contact Liam at
Liam.Garman, Garman at momentummedia.com.au.
You need a shorter email for the purpose of this. Like Liam at something.com.
What's just you reach out to me on Instagram.
On the
Instagram.
Follow us, like us on the Instagram.
I know Scott and Zima, we did have a few people that did send through questions, and so I'm sorry we didn't get a chance to speak to
we're
those.
still piloting this. Like this is still sort of a pilot, so the only people knowing we're going live are those that would be logged into whatever. So we're just getting the bits right. We're getting our rhythm right with the podcast in terms of timing and tempo. But we're going to be using this a lot more to push it out. So, but you probably, a lot of you guys and girls are tuning into this after the fact on a podcast, and hopefully a lot of that's informative. The idea of this is that when people are driving out on a Saturday, look at properties, you stick this on and you listen to us in the car, and it gives you a bit of a sense for what's happening and what's taking place. So you're up to the moment. But expect interest rate rises. Yeah. People, expect it. That's what happens with inflation.
It does.
Yeah. Anyway. We'll be right. Thanks for tuning in. We'll see you again next time. Until then, bye-bye.